started. So again, free version. So it might end in half an hour. In case it ends, you can just join back in the same link, and we'll resume wherever we will be stopping. So coming to capital budgeting, so here we have basically in the problems they'll ask us to calculate these 4 or 5 things. One is a payback period, one is a average rate of return, one is net present value, one is internal rate of return, one more could be profitability index. So 4 or 5. This has been marked important in one of the question for one of the questions. So this could be uh, there in the examination. It could carry 10 marks, can also be a 15 or 20 marks question. This has that much of importance and uh, so very quickly starting with it, the payback period. Give me 1 second. Yeah. So the payback period, when you simply talk about it, the payback period is nothing but in how much time will you get back the initial amount that you're investing in a particular project. So if I'll tell you that suppose I'm investing in a project and I'm investing suppose 5,000, and per year I'll expected, we don't know how much we'll get, but expected per year we'll get 1,000. That means we simply divide 5,000 by 1,000. That means in 5 years we'll get back the money. uh, so our payback period is how much? 5 years. So in any doubts in that? So similar example if I give, suppose I'm spending 12,000 in the beginning, then per year I'm suppose getting 2,500. Then in 4.8 years I'll be getting back my initial investment. So that's what is payback period. So the payback period is the number of amount of time in which I'll be getting back my initial investment from the returns. That's very simple actually. It gets slightly complicated when the cash flow is not equal in every year. So you guys might be hearing a baby sound. It's my sister's kid is here, so he might disturb us a little bit in between. So just bear with me. Um, any doubts in this? Otherwise, I'll complicate it.
No.
No, right? Yeah, cool. So
So,
what? Yeah,
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 Dheeraj, just
yes,
one point for clarification of
yeah, yeah,
this is the direct payback period method, right?
yes. So are
Does
you
that
referring
mean,
to discount payback period?
no, so I just want for everybody's clarification that when they ask in four different ways payback period, right?
Mm-hmm.
One is the ARR, one is IRR or whatever it is. This is the
Mm-hmm.
basic payback method.
Yes, yes. So I have not started with ARR. I have not started with IRR.
Yeah,
So those are
and I'm
all
just
different
saying for
calculations.
everybody,
Yeah.
absolute, everybody's thing, it is just basic. If there's
Yes.
nothing given and they say payback period, this is what it should be used.
Yes. 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 Absolutely correct. That is absolutely correct. So um, coming back to our example, suppose in this example itself, the 5,000 we are investing in the project, and then we are getting 1,000 per year. Instead of 1,000, suppose in the first year we are getting 500, second year we are getting 800, third year we are getting 1,200, fourth year we are getting suppose 1,500, fifth year we're supposed getting 2,200, then suppose it goes back to 650, and so on and so forth. Suppose this is an example, and this is what you are getting in from first year to 1 2 3 4 5 6 6 years. So can somebody tell me how do we calculate that? Now you understand what is the payback period. Now if you what is that? The payback period is nothing but the time in which we are getting back our initial investment. When it was yearly amount was equal, that was very simple. By simply dividing we are able to calculate that. Now that the cash flow is different in each year, how do we go for it? How do we calculate in which year are we getting back our full 5,000? Can somebody suggest? Very simple mathematics. One more thing, when we are in the question, so we don't know whether the end semester exam will be online or offline. In case it becomes offline, all of this calculation will be needed to be done in the calculator. So, what I had thought earlier was, because earlier I thought it would be offline only. So while practicing, I had thought of actually having a calculator in hand and telling how to go for it. Anik is asking, can somebody reply that it's already started there? So now I'm not sure. I'll be doing here only, but in case calculator will be needed, you need to practice it before the exam, because otherwise you tend to make mistakes. You tend to really have a slow pace, and you lose a lot of time in those calculations because of that. So in case we are going for an offline exam, do practice on the calculator with these big calculations, Okay, having that said, any idea, anybody got any idea, how do we go forward with this? How do we
We
calculate the
keep
pay?
adding, and after the fourth year, we have very close to 5,000. So
Okay,
in the middle
how
of the
did you
fifth
figure
year,
out?
I think we'll be done.
Okay, how did you figure
We
out
go on
after
adding
first
one
year?
by one.
Yes. So basically, that number is called cumulative amount. So cumulative amount is nothing but each year you add whatever amount you have received. So in the first year you have received 500. Second year you're receiving 800. So in total you received 1300. Third year you received 1200. So in total you receive how much? 2500. And similarly for fourth year you are in total you are receiving 4000. And for fifth year 6200. In sixth year it's 6850. Now, like you said very rightly, it's the fifth year in which we are reaching to that 5000 number. So if I'll have to calculate the exact number of years in which I'm getting back my 5000, how do we approach it? Simple mathematics. If you just think about it, it should click. So till fourth year, let me give you guys a hint. Till fourth year, we have already received how much?
4,000.
4000. How much are we left to still get?
1,000. 1,000.
1000, right?
House.
So if we have to get 1000 from which year? Fifth year, and we have got 2200 in the fifth year, in what time did we receive 1000? I'll repeat that question. That
1,000 by
become
2200.
absolutely correct. For others who did not click right away, what we did was, till fourth year we have got 4000, so we are left with 1000. In the fifth year we have got 2200. So basically, in fifth year, in how much of time have we got 1000? In total year we have got 2200. 1000 we must have got 1000 divided by 2200. So if I do 1000 divided by 2200, that gives me 0.45. So 4 years is already gone, obviously, because in 4 years I'm getting 4000. So this 0.45 is from fifth year. If I add these two, 4.45 is my answer. So payback period is 4.545 years. So if I tell that in the exact same other language that I was telling, in 4.545 years, I'm getting back my 5000 of initial investment. Any doubts, guys? I'm expecting some questions here. Any doubt about this 0.45? How is it calculated? All clear?
Yeah.
Okay. Now, if you are clear, let me show you one of the questions. Here it is. Tell me, so initial investment here, if you can see, is 350 for project M and 350 for project N. 1, 2, 3, 4, 5, 100, 150, 400, 450, 300. Let's focus on project M only. What is the payback period for project M? Can somebody tell?
2 years plus
2.25.
2 years, you said
2.25.
2 years is wrong. 2.25 is the correct answer. If somebody has not done, please do for project M. For those who have already done for project M, do it for N. How much is for N?
Plus
2.14. I guess.
Perfect.
by
2.14 is the correct answer. Others, are you able to do it? Are you facing any challenge?
Dheeraj, can you please repeat that method again?
Yes, yes.
Yeah.
So how we did it was, in the first example when we simply calculated each year how much of total did we receive. That's what is called cumulative amount.
Yeah.
So the first year we received 500, second year we received 800. That means at the end of the eighth year we have received in total 1300. Similarly, in the third year we received 1200. So in total that becomes 2500, right? In the fourth year that becomes 4000, and so on and so forth. Now that we have to calculate 5000, in how much of time have we received back 5000? If we look at it here, in between 4 and 5 the 5000 lies. So after fourth year, in the fifth year, somewhere in between, we have got back the 5000. How do we calculate that proportion of time to the exact proportion of time is like this. 5000 is our initial investment. 4000 we have got it in 4 years. How much is balance?
1,000.
1000. In fifth year, in total, we have got how much?
6,200.
No. In total, just in fifth year, not the total one,
Okay.
just
6,200.
1200. So we
Yeah.
have to get 1000. We have got 2200. So in how much of time in that fifth year have we got back that full 1000? We simply do 1000 divided by 2200.
Okay. And
That
add
comes,
to the
yes,
4.
that
Yeah.
add to the 4. Yes, absolutely. And that makes
Yeah. Got
sense,
it.
right? Don't cram it. Don't remember the whole process. Try to understand that why we are doing it. That will actually help you in solving. In case you forget steps, you can actually recall and why we were doing it, and you'll be able to solve the question in the examination hall. Then you add 4 plus 4.45, as you said, so 0.45 as you said correctly, and that gives us the payback period. Now try
Okay.
with this question, project M and project N. If anybody else is facing any doubts, please let me know. Otherwise, I'll move on to the next concept because we are done with the payback period. I'll just wait for one more minute if anybody has any doubts.
So
I'll post.
350 is the initial investment in this question, right?
Yes. I'll just post this question in the WhatsApp group in case somebody is already doing it. Uh, I have just done it. If you guys are referring, you can look at there. Yes, 350 is the initial investment, whichever is in negative now in bracket, that's the initial investment. So what happens is this is a financial language only. So when something is written in bracket, that means that's a negative value. So when we are talking about cash flows, if something is in negative, that means that's cash outflow. So if something is positive, that's a cash inflow. So the moment you see the year is zero, that means that's a present time. Year is 1, that means after 1 year. Year is 2, that means after 2 years. So similarly, year is 0, that means present. So at present, the information given is at present there is a negative cash flow of 350. That means that's the initial outflow. So that whole logic of that's how they read it out. I mean, that's how they write it. Standard language only. Okay, so if anybody is already doing it, you can refer to that image. I've already posted there. In case you are having any doubt, you can stop me in between. That's all right. We'll go back to that discussion. No problem. So I'm bringing in one more concept. It's related to the payback period, not just payback period, all the concepts that we are going to discuss. So there is this concept of income and cash flow. Can somebody tell me the difference between what is income and what is a cash flow? Because there is a big difference. What is a income and what is a cash flow?
So
Or do you,
income can be something which is on the records.
yeah.
Cash flow is when the cash actually goes out of hand or comes in.
Absolutely. So if I say in just some other another language, so I might be having a lot of income, but I may not have cash flow. Am I right?
That's true.
Other way around also it's possible. I may not have any income. I may not be maybe having a lot of loss, but I'd be having a lot of cash flow. Anything is possible. So I mean, the answer is in the language only. I mean, income is what? Income is profit or loss. Very simply, we do some calculations. We deduct the expenses from profit. We calculate the income. Cash flow is hard cash. Any cash that you receive for whatever purpose, that's the cash flow. So both are totally different. Why I'm pointing this out? Often our whole capital budgeting, when you look at it, all the information those are given will be cash flow, because that decision of capital budgeting is based on cash flow only. Only and only on cash flow, not on net income, not on income, not on profit, rather on cash flow. How much of cash we are paying in the beginning, how much of cash we are receiving in the throughout different years, and we all the analysis that is done, whether it's IRR, whether it's NPV, all are done on the basis of cash flow. So if in one of the questions, instead of the cash flow, they give the income. So what I said is, I'll repeat, if in one of the questions, instead of income, they give, sorry, instead of cash flow, they give the income, we will have to calculate the cash flow. Now, how do we calculate the cash flow? That's the question now. Suppose I say for one of the years, my income is 1,000. My income is 1,000. My during the year, suppose we have charged depreciation of so when I say income, it is after all the expenses, so after the depreciation only. Suppose I had depreciation of 200 during the year, and suppose my tax rate was 25%. Now with this information, actually the cash flow can be calculated. Now how do we do it? um, Basically, if you look at it from this perspective. Okay, give me 1 second. I'll okay, so okay, yeah, so let me just change that number a little bit so that we avoid complicated numbers. So suppose my income was, revenue during the year was 1,800. For example, just for example, think about it. Suppose my revenue was 1,800. So I got cash of 1,800 during the year for sure. Okay. Uh, so revenue is income also, I'm saying. And from that, suppose we have depreciation of 200. So we deducted that 200, and by deducting 200, we calculated income before tax, or profit before tax, you call it, of 1,600. I might deducted that, and then I calculated the tax at the rate of 25% on 1,600, and that comes to 400. After deducting the tax, I get a net income of 1,200. Now, if you look at it, 1200 is given similarly income here, and 1200 is the income that we are getting. Now look at these items. Out of these items, there is one item for which we don't have to pay cash. Can somebody tell me which one is it?
Depreciation.
Absolutely correct. So depreciation is, the nature of depreciation is we don't have to pay cash for it. That's what creates problem at the time of calculation of cash flow. Out of all the expenses, one expense or some expenses are there for which we don't have to pay cash, but we deduct that for calculating net income. Reason is what? Because that we consider it as a expense. Even though there is no cash outflow, still we consider it as an expense, which is exactly why we deduct it. But now that cash flow is important for us when we are focusing on capital budgeting decision. So now we have to calculate the cash flow. In order to do that, how do we go forward? How do we go from 1200 to the cash flow? Now forget about going from 1200. When you look at this number, 1800 you got revenue, depreciation is 200, your PBT comes to 1600, tax is 400, and net income is 1200. My question to you in very simple language is, how much of cash have you received in this year? I've already given you a hint of depreciation is a non-cash expense. We have not paid anything for that depreciation. For everything else, we have paid or received. Now you tell me how much of cash we have received during the year.
1400.
1400 is answer. Anybody else?
1800.
1400 one answer, 1800 one answer. Okay. Anybody else?
So 1800 is what we totally got.
1800 is total got. Now, I mean, what is the net one? There are some
Net.
expenses, right?
Yeah. So the revenue was 1800.
Mm-hmm.
But 200 we have already spent earlier. So
Correct.
that we are just offsetting it right now.
Correct. How
So
about
1600 is what we get in hand,
okay?
which is used now. Beyond that, we pay taxes and others, but in hand cash, if you really look at it,
Okay.
after taking that 200 out is 1600.
Okay. Okay. 1600 you are saying. Okay. Anybody else? Any other answers? Okay. So the answer, the correct one is actually 1400. I'll show you how. If you look at these, okay, this is an inflow. Now this is not an inflow, not an outflow. This is nothing. I'm not considering it at all. This one, the tax is an inflow or outflow, or do we have to pay something for it? Outflow, right? We have to pay the tax. So if you look at it, only two items is relevant are, one is revenue inflow of 1800 and tax outflow 400. If you net those, that comes to 1400 of net cash flow that you are getting for the year. Now the calculation becomes a bit difficult when you are going from income. When you have 1200 in mind, then you start calculating, that becomes complicated. But when you look at the whole picture, that becomes slightly clearer. So if you go from 1200, how do you approach it? If you go from 1200, you simply add the depreciation. You go from income, which is 1200. You add the depreciation, that's 200. That comes to 1400. Am I right? That can be everybody. Yeah. So, but let's go for this in detail, whatever we have done, right? In detail, whatever we have done. Basically, you add 1200, 200, and that also can be done. You simply deduct 1800 and 400. That also can be done. Anyway, is fine. Now, now in this question, if you look at it, there are few projects that are given, and the question reads something like this: Congo and Sons is considering two mutually exclusive project. Both need an initial cash outlay of 10,000 each and have a life of 5 years. company's required rate of return is 10% and pays tax at 50% uh, rate, the projects are going to be depreciated on a straight line basis. The before tax cash flows expected by the project are as follows. There are a lot of information those are given. Only two information you have to focus as of now. Others I'll tell how they are relevant whenever we are going to that relevant particular method of calculation in this capital budgeting. Right now, only two things those are important are, one is cash outflow is 10,000 for each of those projects. Second one is tax rate of 50%. First one I said 10,000 cash outflow. Second one is 50% is the tax rate. Okay. Now what they're saying is the before tax cash flows expected by the project are as follows. The last one says before tax cash flows expected are as follows. So basically what they're saying is in the first year before tax, the cash flow is 4,000. So basically they're giving this revenue value. This revenue value, whatever we had taken as an example, that's what they're giving, that this much of cash that you're receiving from this project in the first year. So if we forget everything else and just focus on the first year, okay, in the project P in the first year, the amount that we are getting is 4,000. What is the amount? What is the depreciation amount? Can somebody tell?
50%.
Depreciation. 50% is the tax rate. What is the depreciation amount?
800.
No. 800 is the wrong answer. How did you reach to 800?
I was thinking it is straight line basis, so divided by 5.
What divided by 5? 4,000 divided by 5?
Yeah.
No, 4,000 is wrong. Something else divided by 5. The divided
10,000 divided by
10,000 has to
by
be divided
5.
by 5.
absolutely correct. So our depreciation is 2,000. So if our inflow is 4,000, our depreciation is 2,000. What is our PBT, profit before tax? That comes to 2,000, right? And now
Yeah.
tax rate is how much? 50%. So we'll be paying tax of how much is equal to 2,000 into
1,000.
50%. That comes to 1,000. So basically our after tax profit is net earnings is 1,000 only. So this is your net earnings, net profit or net earnings, whatever we can call it. Now in the same logic, how much is the cash flow for this year from project P? Can somebody tell how much is the cash flow?
1,000 plus 2,000, 3,000.
Absolutely correct. The other way around, can somebody tell what is the other one around? Something minus something?
4,000 minus 1,000.
Yes, absolutely correct. So I'll just write down those items so that it will be catchy for everybody. 1 second. Okay, so no, mistake. Revenue is 4,000, depreciation is 2,000, PBT is 2,000, tax is 1,000, net earnings, that means net income is 1,000. We know that depreciation is a non-cash item. So we have received 4,000. We have paid tax of 1,000. We simply do 4,000 minus 1,000, that comes to 3,000. Other way around, like I have said, 1,000 plus depreciation also 3,000. That way also you can calculate. Any doubts, guys?
No.
Okay.
No.
Okay, awesome. Now that we have done it, now remember, why are we doing it? That's the biggest question. So for capital budgeting, cash flow is the basis for every decision. But in the question, they may not give the cash flow directly. They'll give the net income, or this, like they have given cash flows before tax. And from that, we'll have to calculate the cash flow. Now, for each and every year of the both projects, we'll have to do this calculation. Now, here is a format in which it has been simplified so that we can calculate this amount very quickly and not without any too much of calculations here and there. Now, if you look at this table, this is just a horizontal version of this vertical table. This is just a horizontal version of basically they have transposed this table. So we had 4,000 here, 4,000 is coming here, 2,000 is a depreciation, 2,000 was here, 2,000 was profit before tax, that's coming here, tax is 1,000, that is 50%, that was here, and then profit after tax, that comes to 1,000, and then CFAT is nothing but your 1,000 plus 2,000, the other way around is 4,000 minus 1,000, that also you can do. Similarly, for the rest of the years when you calculate, you get exactly 3,000 only. Can somebody tell me why this is coming same for all the years?
The revenue is same.
Exactly. The revenue is same. Revenue is 4,000 for all the years. That's exactly why you are getting cash flow of exactly 3,000 for all the years also. Exactly. But if you look at the project Q, that is 6,000, 3,000, that is different, for which we'll be getting different cash flows. If you look at cash flows are different for those. 4,000 for first year, 2,500 for second, third year 2,000, 3,500 for fourth, and fifth, so on and so forth. Now for you, please do this calculation in your notebook or in your system wherever possible. Otherwise you tend to forget this calculation. When we were solving it, I told you which item to pick, where to calculate, and I asked that important question, how do we calculate cash flow? By adding something, deducting something. But when you don't do it, you tend to forget what to do, which one to add, what to calculate. So once you practice only, you will be able to remember that aspect of it. Now that we have calculated the cash flow from here, you guys tell me what is the payback period for both of these projects. So I'm highlighting the cash flows for the first to fifth year for both the projects. The first one is project P and second one is project Q. You tell me what is the payback period.
These are just the initial investment given here.
10,000, no? We have calculated depreciation on that
Okay,
basis, no? Yeah,
Yeah, got it.
At the first year is 3.33.
perfect. That is
Yeah.
correct. Second,
3.42.
that is correct. 3.42 is correct. Did everyone get the answer? Do you want my help? I'll give a different version of this question so that you guys can practice. I'll also give the answers, and you can match after calculating the answers, like similar to what we did in the last semester. No, but you need to do that. Otherwise you I'm telling you, in 15 days you will forget all this for sure. This is completely new for you, so. And it's so many things are there for us that you tend to forget the first one when we'll be reaching to capital rationing and others, no, you'll be able to you'll be perfectly forgetting all this, so better to practice. Now if somebody is having any doubts in the calculating, stop me stop me and ask me. That's all right. I'm moving on to the next one. So we are going to average rate of return now. Average rate of return is a very simple thing. So when let's talk about rate of return. Okay, so you must have seen rate of return in a lot of places. When you take a loan, there is a rate. When you are having a savings account, there is a rate, and many other places. How do we calculate that rate of return? If I give you that, suppose you have invested 12,000 and you have got 1,200, what is the rate of return you have got here? Can somebody tell?
10%.
10%.
10%.
Absolutely, that's very simple, isn't it? So 1,200 divided by 12,000, that comes to 10%. Now similarly we can take so many other examples. We have invested this, we have done this. Here is let's complicate the thing a little bit instead of discussing those simple ones. Suppose you invested 12,000. In the first year you got 2,000. In the second year you got 3,000. What is the rate of return?
2.5.
2.5 you said. How did you do it?
I'm not sure. I was
Point
thinking
208.
average.
0.208 you said. 0.208.
Yeah, 0.208. It is 5,000 divided by 2 divided by 12,000. So average we have to calculate.
Okay, so you're saying basically 2000 plus 3000 you did, and then you calculated the average of it, then you divided this by 12,000, right? Okay, anybody else? Any other answers? So if you think about it, if I'll just give you one more type of answer one can give is, he'll say in the first year we have got 16%, in the second year